Everybody's turning bullish, freakishly so, and I'm going to outline a pretty clear case as to why I believe the lows are not in, and that predicting at least the same ballpark as the ultimate lows of this cycle. Again, you don't have to buy the bottom, but understanding what era, what general world we will be in when the lows start to show themselves, that is the world that I like to trade within. And again, you don't have to be perfect, but I believe predicting these lows will be the single most important factor in building exponential wealth over the next decade. That's right, I believe this bear market may very well be one of the last bear markets we see in risk assets for quite some time. I believe it'll be a brutal bear market that will take quite a while to reverse, and when it does, I believe those who hold assets, who are in a position to build wealth and grow their portfolios, I believe those people will hold the keys to the future of wealth creation and preservation. But given the pace at which wages and their actual real value are downward spiraling, those who are not in a position to emerge from this period victorious with some amount of wealth being built in risk assets or assets in general, I believe that window will be very difficult to close, unless of course you're in the 0.001% of people who have wild success in whatever profession they have. So with that said, let's dive in and I'll show you the warning signs that I'm looking at right now and why I think the lows are not in. But of course, spotting when the bottom may form and in general starting to average into the market, I'm going to give you my strategy to make life-changing amounts of money from that pivot in risk assets. If you're excited for this, destroy that like button, make sure you subscribe with that bell notification on, and let's dive in. First off, let's just spit out the facts. The market has gone from max fear at the bottom of this recent sell-off in June to max FOMO. As you can see here, we are rebounding from one of the most bearish sentiments, the sum of QQQ delta across strikes and expiries out of 6 months. As you can see here, we've gone from max bullish sentiment right before the Fed pivot in November to max bearish sentiment here around the middle of June. And now we're rebounding again to max bullish sentiment. This, of course, has voiced itself with such magnificent coins such as every meme coin under the sun, going absolutely parabolic here on Dogechain. Of course, the EVM compatible chain that works off of Dogecoin. This is some serious Degen stuff. Remember, bear markets don't end when everyone jumps into the most risk-on, degenerate, valueless, short squeeze Wall Street bets like opportunity just for a quick pump and dump. No, bear markets end when people stop being degenerate, when people lose interest in the upside, when people return to fundamentals and start treating value as such and start treating fake value as such. The market was filled with so much speculative excess due to the money printer dousing anything and everything in artificial pumpery. That needs to come down to earth. That is the true point of a bear market, is to bring that speculative excess back down to earth so that people spend money on the important things, invest in the good stuff, and we don't just turn the world into one big casino. Now, do you really think that that's happened looking at Bed Bath & Beyond pumping aggressively, so much so that they had to halt trading? Of course, this reeks of Wall Street bets, which is, of course, not a focus on value, but quite fundamentally the opposite. But let's get real here. What is going on in the markets? Well, by most estimates, this is a technical rally, meaning that the charts were just oversold. Nothing goes in one direction forever. The charts are like a rubber band. When you stretch them in one direction for too long, they come back. But that does not mean that we've ended the bear market. It does not mean that the bear market has done its job by crushing demand and reducing inflation and doing all the things that were necessary in order to bring the economy back into a healthy position long term. So let's be real here. What are people celebrating? The peak of inflation because oil prices came down, which is generally energy cost coming down? Well, let's take a look at these stats that tend to refute everything about the idea that energy cost is fundamentally coming down. Instead, it's a very scary point that the United States has artificially emptied their oil reserves to artificially bring down the cost of oil short term. And guess what? They can't do that forever. Breaking, the US EIA crude oil inventories are actually minus 7.06 million, and they were forecast to be plus 0.8 million, previously almost 5.5 million macro. With the release of 180 million barrels from SPR, the US has attempted to artificially mitigate inflation. The two main issues are that the cost of energy from other natural resources is still rising, and oil will likely bounce back once the US reserves start running thin. Just literally ignore this, because this is not the Bitcoin chart. This is not the Ethereum chart. This is not the Dogecoin chart. This is the price of natural gas. And as we start approaching the winter, as people need to heat their homes, this is going to be very, very relevant. Remember what we were talking about people in Germany rushing in to buy firewood. This is where we're headed. It's the 1800s all over again. As Lynn Alden points out, the huge spike in European energy prices may make industries globally uncompetitive. Unless they fix the problem soon, they'll have to shut down or move elsewhere. Here we have another large zinc smelter in Europe will close indefinitely due to sky-high electricity prices. The zinc market was already tight. This may also impact silver production, as 35% of global silver supply comes as a byproduct of zinc and lead mining. We have reports of the U.S. emergency crude stockpile falling to the lowest in 37 years. Of course, we have the anecdotal evidence here, which we need to obviously compare apples to apples, but 1 year later, an energy bill that was 120 euros is now 978 euros per month. That is a massive, massive increase. Obviously, we don't know exactly how much was consumed, but we know that there is a massive increase here. This anecdotal stuff you have to take with a grain of salt, but what we're seeing, both anecdotally and on the charts, is an absolutely unthinkable increase in energy cost. And although inflation might have tempered itself down for the brief minute that we're in the United States, we have England clocking in at 10.1% inflation year over year, and that is after a forecast of 9.8. Previous was 9.4. England and its Great British Pound is on a massive downward spiral, even more aggressively than the US dollar versus goods and services. And let's not talk about the consumer being super strong, as Target missed huge on its earnings and now has such an overabundance of the wrong types of inventories that it's having literally apocalyptic sales of 70% or more on certain items. If you want some cheap stuff, I'd suggest you go over to Target, because they're desperately trying to clear their warehouses. Meanwhile, we have an administration where every single thing they do to control inflation ends up creating, inflation. Let's go ahead and check this out. GM, Ford CEOs push for EV credits and chip funding at White House. What do they get? A $7,500 tax credit. And what happened? Well, they waited 6 months and then they raised the prices of their cars by exactly what? $7,500. You really can't make this stuff up. And finally, to drive my point home, we have U.S. retail sales month over month, actually 0%. It was forecast to increase by 0.1%, and it was previously 1%, which means the growth of the economy, the growth of retail spending is actually zero, as Joe Biden would say.
Zero.
So what's the way to play this? How is there a way to make the most amount of money here? Well, in my opinion, patience, 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 as this current bear market rally is almost exactly reenacting the 2008 great financial crisis and the stock market collapse of that year. There are always vicious bear market rallies throughout 2000, 2008. Of course, this time could be different, but to me, there's no upside when meme stocks are rallying, when absolute degeneracy is taking place, when FOMO is coming out of people's eyeballs. Really, it behooves everyone to take a step back, take a breath, and zoom out. The economy is in deep trouble. China's real estate market is collapsing. We have America's real estate market in deep trouble. Consumer sentiment is low. Retail is slowing down. Energy prices skyrocketing. Crude oil reserves are running out. And the only thing we're celebrating is inflation at 8.5%. I mean, that is a real raw deal. In my opinion, sitting on your hands right now is the ultimate strategy. Because of course, when the music stops, I believe from this bear market rally, we will see a massive crash. Remember, the bear market ends when people don't believe another bull market is even possible. And the bull market ends when people can't believe a bear market is possible. That's exactly what happened towards the end of 2021. In fact, I was guilty of even saying it myself. I'm not sure if we'll get another bear market. I should have known that when those words left my lips, that it was time to buckle up, because a lot of downside pressure was about to take hold. But nonetheless, you live, you learn, and you get better. At this point, I believe that there's way too much FOMO in the market. The classic bear market rally is in effect, and it's getting people off the sidelines. It's getting people to be exit liquidity for the bigger money bags who didn't take enough off the table earlier in the year, back when they had the chance before the Fed pivot. Now, when this happens, buying the bottom on risk assets, buying into the general ballpark of the bottom on risk assets, I believe is the ultimate way to ride this market up. And while that's going to happen, well, real estate will probably take a lot longer to decline. You see, the real estate cycle back in 2008 didn't hit its bottom until over a year after the actual stock market bottom. So there will be a year of growth in risk assets before the real estate market will bottom. So figuring out how to average into things like Ethereum, in general, metaverse and crypto coins that I believe will be the future of the digital world. And then, of course, diversifying some of the gains you get into a cheap and underperforming real estate market. Well, that to me is an ultimate strategy for the decade. That is a 7 to 10 year plan that will allow smart investors with capital on the sidelines to more than 10x, probably close to 100x their portfolios. But more disturbingly is the fact that once the money printer does go back on, there will be very few options. The economy will be in such a dramatically bad place that it's unthinkable that they will be able to crush demand and crush the economy without sending the United States, or really the global economy, into a long-lasting recession or depression. I believe this could be one of the last financial corrections before hyperinflation really takes hold. And that means that asset ownership, property ownership, company ownership are going to be things that appreciate versus the dollar in such an aggressive way that those who do not hold them before this period begins will be unable to ever afford them afterwards. This to me is the golden moment where those who play their cards right, who put money off to the sidelines, who invest strategically and intelligently in risk assets in the future of the digital world, the people who imagine what the world will be like in 10 years and who are able to accurately predict even a few of the changes coming to our society, and of course invest, build, and work towards being a part of or an owner in that world, those people will be able to create incredible amounts of wealth, control their destiny, and avoid probably one of the biggest pitfalls of the changing economy we live in. Of course, I'll be giving you my play-by-play approach to these markets, and I sincerely hope this helps you. As always, my name's EllioTrades. If you enjoyed this video, please destroy that like button. Of course, it's all we ask of you here at EllioTrades. As always, if you're excited to see my step-by-step strategy, how I'm building towards the digital future, building my portfolio around it, how I plan to diversify some of the gains I will be making in this digital world to make sure that my portfolio is robust and diversified, make sure you subscribe and put that bell notification on. As always, my name's EllioTrades. You can find me on Twitter at EllioTrades, and I'll see you very soon on the next episode.